Well, the U.S. Federal Reserve Board's Open Market Committee has signaled a willingness to pause its interest rate hikes in June. But just like in Canada, persistent inflationary pressures in the U.S. economy may force the Fed to raise rates again. Our next guest is a leading U.S. economist, Lindsey Piegza, chief economist at Stifel. She joins us now from New York. Lindsey, thanks a great deal for joining us. Great to have you with us. You wrote very recently, the committee, referring to the Open Market Committee at the Fed, has indicated a willingness to move to the sidelines in June and may still do so. What do you think will happen in June?
Well, it's going to depend on the incoming data, but it's very clear that the Fed has opened the door for a potential pause in rate hikes. But I do want to caution that if, in fact, the committee does decide to take a pause, it will be in spite of the latest data, not because of the data. What we're seeing in the U.S. is still solid growth, solid activity on part of the consumer, and, of course, the most important thing, still sticky levels of inflation well above the committee's 2% target. That being said, there is a growing conversation among officials to potentially take that pause, at least temporarily, and allow the banking sector a little breathing room, allow additional time to assess the earlier impact of 500 basis points of tightening. But again, at this point, the data does not suggest any sort of end to Fed tightening, not quite yet.
So the rationale to pausing would be, I guess, similar to the rationale that the Bank of Canada outlined earlier this year in February, a willingness to watch the data and respond as appropriate.
Exactly. It would be changing their storyline from raising rates while assessing to pause and assess. Again, Fed officials coming out talking about that varied and potentially long lag between the real impact on the economy and earlier Fed tightening. And so they want to give themselves ample time to really evaluate the incoming data and again also assess ongoing volatility or unease in the banking sector in order to make the most appropriate decision. But I do think that any decision to pause would be a temporary decision before the Fed has to move back into further rate hikes in order to get inflation under control.
You've also noted some optimism around the other big event that people around the world are watching in the U.S., and that is the political standoff and ongoing negotiations over raising the U.S. debt ceiling. Do you believe we are headed to an agreement soon?
I do. I hesitate to say soon. I do think the deal will be made in the final hours behind closed doors under the cover of night. It really is, I think, somewhat frustrating that something that had been historically procedural has become such a contentious point of political theater, if you will. But in the end, particularly with a very important election coming up in 2024, neither side of the aisle wants to be seen by voters as the reason that the U.S. Potentially faces a default. And so in the end, cooler heads, I do suspect, will prevail. A deal will be met. But the damage, the uncertainty, the volatility has already impacted markets.
I'd love to get your thoughts on the state of the U.S. consumer. One thing we've heard from big U.S. retailers like Target, Home Depot, and even Walmart, which reported a better set of financial results, but did caution that it sees consumers slowing down their spending. What is your take on the U.S. consumer right now?
Well, as we saw in the latest retail sales report for Canada, consumers are struggling globally under the weight of rising borrowing costs, increased inflation. But in the U.S., we've seen a surprising level of resilience on the part of the consumer. Consumers willing to draw down still levels of pandemic savings, still relying on a last sputtering of state and local stimulus. And most importantly, American consumers are turning to credit cards at a rapid pace to supplement spending. Now, that resilience is likely to carry into the second quarter as the household balance sheet was starting from a relative position of strength, given the paydowns of earlier debt balances during the pandemic. But that being said, these are still temporary factors that we do expect will begin to more precipitously wane in the second half of the year as the Fed presumably continues to raise rates in its fight against inflation.
Things are very different in the two countries, Canada and the U.S., with respect to household balance sheets. I think you might agree. The Bank of Canada, as you know, has been warning Canadian households for years through a succession of governors of the Bank of Canada to take it easy on household debt. During that period period of low interest rates. They caution that interest rates will not stay low forever. And the Bank of Canada, just yesterday, when it released its financial stability review, pointed once again to elevated levels of household debt and mortgages rolling over in the year to come as a significant source of strain on the financial system. How different are things in the U.S.?
Oh, very different. So when we look at household debt payments relative to disposable personal income, in the U.S., we actually saw that fall to a multi-decade low. So I'm certainly not advocating for American consumers to take on new amounts of debt or new amounts of credit card debt. But what this tells us is that in the U.S., the household balance sheet can certainly give support, I should say, additional runway for new amounts of debt accumulation for at least some time going forward. Again, supporting the thesis that we will continue to see this resilience on part of the consumer, at least in the U.S., through the second quarter, perhaps longer. But eventually, these temporary factors, as Canada is now feeling the pressure, will undermine the consumer's ability to spend, resulting in much slower growth, not just in that top-line consumption number, but in overall top-line GDP.
Finally, do you have a call on whether the U.S. economy is headed to recession later this year or early next year?
Well, I think the debate of whether we see a downturn or recession is largely an academic debate. But I do think as the Fed continues to raise rates, that will tap down investment, tap down consumption, and eventually lead to significantly lower levels of top-line growth, potentially falling into net negative territory by the end of this year.